Most of the content you'll see about property investing focuses on where to buy, and that matters, but I think the more useful question right now is where to avoid, because the cost of getting it wrong is significantly higher than the reward of getting it right. So I ran my filters across more than 15,000 suburbs in Australia. Only 35 passed at even a high level, which means the overwhelmingly majority of suburbs in this country do not meet the criteria for a sound investment. In this video, I'm going to show you the specific types of suburbs that my filters reject, and I'll walk you through the actual data so you can see exactly why they fail. By the end, you'll know how to spot these warning signs yourself before you commit your money. Most investors assess a suburb by looking at one or two numbers, usually price growth or rental yield, and when the market is going up, that approach works fine because a rising market hides the weak spots. But when conditions shift, and they always do, those one metric decisions are the first ones that get punished. When I assess any property market, I use a supply and demand filter. I've talked about this in previous videos in terms of what I'm looking for, what good looks like, but today I want to show you what it looks like when a suburb fails. So when I'm running these filters, there are specific thresholds where a metric flips from acceptable to a warning sign. Vacancy rates above 2% tells me rental demand is softening. There are properties sitting empty and landlords are competing for tenants rather than tenants competing for properties. The national average right now is about 1.5%. So anything consistently above 2% is a concern. Stock on market above 2% tells me supply is starting to outpace demand. When more than 2% of a suburb's total housing stock is listed for sale at the same time, the area starts to become oversupplied, and that puts downward pressure on property prices. Inventory levels above 3 months means there's a significant backlog of unsold stock. Above 12 months, and you're looking at a market where properties are sitting for a very long time without buyers. That's a clear oversupply signal. And then there are the structural filters. If a suburb's employment base is dominated by a single industry, particularly mining, your property's performance is tied entirely to that one sector's cycle. If the industry starts to contract, jobs leave, population drops, demand drops, and you're left holding a property in a shrinking market. Rising listings combined with falling buyer demand is the pattern that concerns me the most, because it tells you the market is tipping before the median price reflects it. Oversupply shows up in the listing count and the inventory levels months before it shows up in the price. By the time the median price drops, the problem has been building for a year or more. So with that in mind, I want to show you 3 types of suburbs that my framework actually rejects. The first type is what I'd call a yield trap. These are suburbs that look attractive on one metric, usually the rental yield or purchase price, and that single number does all the heavy lifting. I had a client come to me recently wanting to buy off-the-plan units in the Melbourne CBD. They'd heard from a friend that rental yields were strong, anywhere between 5.5% and 7.3%, depending on the suburb. And at a surface level, that's true, those yields are above average. But when I pulled the data on areas like Docklands and South Bank, the full picture looked very different. Docklands has a unit median of $585,000 and a gross rental yield of 6.13%. If that's the only number you look at, it seems like a solid investment. But the 10-year annual growth rate on units in Docklands is negative 0.98%. So for a decade, your property has not only failed to grow, it's gone backwards. It hasn't even kept pace with inflation, which means in real terms, you've been losing money every year you've held it. The 3-year change is negative 4.1% and the 5-year change is negative 0.85%. Prices have been in decline across every meaningful time horizon. On the supply side, there are currently 280 listings in Docklands. The stock on market percentage is 2.59%, which is above the 2% threshold where I start getting cautious. Listings have increased 57% over the last 3 years, and at one stage last year, there was close to 10 to 11 months of stock sitting on the market in some inner city Melbourne suburbs. The vacancy rate is 2.4%. It takes roughly 3 weeks on average to find a tenant, and 70% of the suburb is renters, with the owner-occupier rate sitting at just 30%. When you have that kind of renter-dominated profile, there's very little owner-occupier demand, putting a floor under prices. And the part that most people miss is the holding costs. In newer high-rise developments, strata fees are substantial, and in a lot of cases, you're also looking at special levies for building defects. By the time you account for strata, insurance, vacancy periods, and potential levies, the actual return on your money is far lower than what the yield figure suggests. Now, the same pattern plays out at the other end of the price spectrum, with a suburb like Broken Hill. Broken Hill has a median house price of $235,000 and a gross rental yield of 8.08%. At a glance, that looks like a cash flow machine. Low entry price, high return, but the population has been declining every census period since 2006. It's gone from around 19,500 down to 17,700. The total number of properties has actually shrunk from around 9,650 to 9,610 over the same period. This is a town that's getting smaller. The number one employer is silver, lead, zinc, and ore mining at 7.4% of all jobs. If that mine scales back operations or closes, there's no secondary industry large enough to absorb the job losses. Hospitals and aged care are the next two employers, but they're service industry that depend on the local population. If the population keeps shrinking, those jobs shrink with it. Days on market is at 70, which suggests there isn't strong buyer demand. And while the vacancy rate at 1.15% looks healthy right now, it's been volatile. 12 months ago, it was significantly lower, and the 12-month change shows a 52% decrease in vacancies. So when a client comes to me and says they're interested in Broken Hill because of the yield, the conversation I have with them is straightforward. That yield is compensation for risk. The market is pricing in for the fact that this is a single industry town with a declining population. The 8% yield exists precisely because there's very little capital growth to be had, and the risk of a significant downturn if the mining sector contracts is real. The second type is the oversupply trap. And this one catches a lot of investors off guard because these are suburbs that have genuinely performed well in recent years. The fundamentals may have been strong 12 to 24 months ago, but the supply side of the equation has shifted. And the indicators that would show you that shift are the ones most people aren't tracking. Rochedale in Brisbane is a good example. On paper, Rochedale has a lot going for it. It's 14 kilometers from the Brisbane CBD. It has a 76% owner-occupier rate, the top employer is hospitals, and the median household income is $2,779 a week. The 5-year annualized growth rate is 11.2%. But looking at that trajectory, the 5-year annual capital growth rate is 11.2%. The 3-year growth is 12.6%. The 12-month growth has decelerated to 4.23%. And the last 3 months, 1.13%. That deceleration pattern on its own is worth paying attention to. But the supply side is where the real story is. Total sale listings have increased from 23 3 years ago to 142 today. That's a 517% increase. The stock on market has hit 5.51%, which is nearly 3 times the threshold where I get cautious. Vacancies sit at 2.47%, and it's been volatile. At a $1.75 million median price point, the holding costs are substantial. And when you've got listings increasing 5-fold, while growth decelerates from 11% annualized to 1% quarterly, the market is telling you that supply has caught up with demand. The buyers who were competing for stock 2 years ago now have 142 properties to choose from instead of 23. That competition among sellers is what pushes prices sideways or down. Now, Dora Creek in Lake Macquarie is the same dynamic, but further along the curve. Dora Creek is a small suburb, 1,739 people, and about 836 dwellings. And there are currently 64 properties listed for sale. That's a stock on market percentage of 7.66%. To put that in perspective, I get cautious at 2%. This is nearly 4 times that level. Listings have risen 128% in the last 12 months alone. Prices are down 12.5% over the last year and down 5.35% over the last 3 years. Days on market has gone from 28 at the end of 2022 to 70 at the start of 2026. And the number of potential buyers has been decreasing consistently for the last 3 to 4 years. So you've got supply flooding and demand pulling away at the same time. That combination is about as clear a signal as you'll get that the market has turned. And then Flinders on the Mornington Peninsula is the most extreme version of this pattern. Flinders has a median house price of $2.11 million and the stock on market percentage is 3.04%. Listings have increased 244% over the last 3 years and 416% over the last 5 years. The 12-month price change is negative 48%. The 5-year annual capital growth rate is negative 2.9%, and the gross yield is just 2.33%. At a $2.1 million entry price with a 2.33% yield, you are paying a premium to hold a property that has been losing value while supply keeps rising around you. Now, what connects these three suburbs is timing. Rochedale early in the oversupply cycle, where the indicators are flashing, but the median price hasn't fully corrected yet. Dora Creek in the mid-cycle, where prices have already started falling and supply is deeply elevated. And Flinders is late cycle, where the correction has been severe and the oversupply has been building for years. The lesson across all three is the same. Oversupply doesn't announce itself in the price first. It shows up in the listing count, in the stock on market percentage, in the inventory levels, and in the days on market trend. Those are the leading indicators. By the time the median price reflects it, the problem has already been building for a year or more. And if you're only checking headline growth figures, you'll miss it entirely. There's a broader point here as well. House and land packages in areas like Outer Brisbane, Western Sydney, and Northwest Melbourne carry a similar risk profile because the land supply in those corridors is abundant and developers keep bringing new stock to market. So even when demand is present, the supply pipeline can keep pace with it or outrun it. And that limits how much capital growth you'll see. You need the demand to absorb the supply before prices move meaningfully. And in some of those corridors, that absorption rate is very slow. The third type is the premium price trap. These are suburbs where the lifestyle appeal and the investment appeal has been confused for each other. Mount Vernon in Sydney's southwest is a good example. Mount Vernon has a median house price of $4.387 million. It's a beautiful area, 95% owner-occupier rate, population of around 1,235, crime score 10 out of 100, and the median household income is $3,543 a week. People who live here earn well above the national average, and they've chosen to live in a low-density, semi-rural setting. But from an investment perspective, the numbers tell a different story. The gross rental yield at 1.3% at $1,100 a week rent on a $4.4 million asset, the shortfall between rental income and holding costs is enormous. You're carrying a very large cash deficit every single month. Sale listings have gone from 2 to 6 in the last 12 months, which in a suburb of only 331 dwellings is a significant increase in supply. Buyer demand dropped 33% over the last 3 years, and the vacancy rate has risen to 2.23%. At this price point, even a modest correction is painful. A 5% decline on a $4.4 million property is $220,000. That's roughly 4 years of gross rental income wiped out in a single adjustment. And with buyer demand falling and listings rising, the pool of people who can actually afford to purchase a property at this level is getting smaller. The logic that pulls investors towards these suburbs makes sense on the surface. A wealthy area, high incomes, and a desirable location. But the investment fundamentals and the lifestyle appeal of an area are two separate equations. A suburb can be a wonderful place to live and a poor place to invest. And at premium price points where the yield is this compressed and the buyer pool is this thin, the margin for error is very small. So that's what the data looks like when a suburb fails the framework across 3 different failure modes. But I want to show you briefly what it looks like when the same filters come back clean, because the contrast is stark and it helps calibrate what you should be looking for. I've got a handful of suburbs here across different states. Bli on the Sunshine Coast, Forest Lake in Ipswich, Edge Hill in Cairns, and Canadian in Ballarat. Across all of them, vacancy rates are well below the national average of 1.5%. Inventory levels are under 3 months in every case, and in some cases under 2. The stock on market percentage is below 1% across the board. Long-term growth has been consistent without the kind of volatility you saw in the suburbs I just covered. And the rental yields are healthy without being excessive, which tells you the growth and the income side are in balance. The employment base in each of these is diversified across healthcare, education, government, and retail. So you don't have the single industry exposure that creates structural risk. Compare that with what we just looked at, Docklands with a stock on market percentage of 2.59% and a negative growth for a decade. Dora Creek with a stock on market percentage of 7.66 and prices down 12.5% a year. Broken Hill with an 8% yield, underwritten by a single mine in a shrinking town. If you're looking at investing right now, or if you've been considering a suburb and you're not sure whether the data actually supports it, I'm happy to have that conversation. I do a free strategy session where we look at your goals, your budget, and where the data lines up with what you're trying to achieve. And just as importantly, where it doesn't. The link is in the description, and if you want to see the other side of this framework where I run the filters and show you the suburbs that actually passed, I've done exactly that in previous videos on this channel. Subscribe and go check them out. Thanks again for watching, and see you in the next video.